But what are some other terms that you see that can make or break a deal in terms of lending?
I know a big one for me that we learned over the past couple of years, and I forget the exact term for it, but when you borrow money and you're paying interest on the money that's sitting in escrow that you can't even touch, that just blows my mind.
Yeah, so I've heard that called a Dutch loan. And what that is if you get like an LTC loan, you get a loan to cost, so it's covering some of your capex. So let's do a $10 million property, $2.5 million capex. So that's going to be a $12.5 million project. And let's say your loan is going to be, say, 70% of that. Okay. So that means your loan amount is going to be 8,750,000. For a Dutch loan, you're paying interest on that full 8,750,000, even though you haven't touched the $2.5 million yet for your capex on day one. So then as you do your capex, you start making your bank draws, but you're still paying on the full amount. Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey everybody, welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my co-host, Frank Patalano, with me here today. How are you doing, Frank?
Good, sir. Ready to talk about mortgages today.
Yeah, we are continuing the series on financing. We had special guest Julianne Peterson to kick off this series a few episodes ago, and we jumped into different loan types. In the last episode, we talked about interest rates, fixed, floating, and rate caps. And this episode, we're going to talk about other terms that are in the loan that you may or may not understand completely. And so that's why you're here. And Frank and I will do our best to explain them as best we can. So, are you ready to jump in?
Definitely.
So, um, like I said, we talked about interest rates last week. But what are some other terms that you see that can make or break a deal in terms of lending?
I know a big one for me that we learned over the past couple of years, and I forget the exact term for it, but when you borrow money and you're paying interest on the money that's sitting in escrow that you can't even touch, that just blows my mind.
Yeah, so I've heard that called a Dutch loan,
Yes,
or
that's what it was. I was wondering I can remember what it's called.
and what that is if you get like an LTC loan, you get a loan to cost, so it's covering some of your capex. So if you have a $10 million loan and you have, say, I don't know, $2.5 million capex budget, so your total loan is gonna be, or your 10, well, let me pull out a calculator just so I get my numbers right. Let's do a $10 million property. Okay.
Yep.
And we're gonna do 10 million, $2.5 million capex. So that's going to be a $12.5 million project. And let's say your loan is going to be, say, 70% of that. Okay. So that's going to be 70% LTC. So that means your loan amount is going to be 8,750,000. Okay. For a Dutch loan, you're paying interest on that full 8,750,000, even though you haven't touched the $2.5 million yet for your capex on day one. So then as you do your capex, you start making your bank draws, but you're still paying on the full amount. So that, I have seen loans like that. I don't recommend them. I recommend you find out the what they are, what the bank terms are in regards to that up front, so that you don't blindside yourself. But
So let's
like
just
an
talk about what the banks are thinking with this. With the bank, these are more for local banks that aren't going to be selling the loan to somebody else. And the concept is that they have to put aside money that you're going to be using. They can't use it for anything else, so they might as well pay. They might as well collect interest on it.
yeah, okay,
Not a fan of it, but
yeah. Um, and another thing though I've seen is, and this is more typical, is you're only going to be charged like interest only for say 2 years, and then after 2 years you're going to be charged the full amount on everything. Um, so what the bank is thinking in that regards is they're going to charge you as you make draws for 2 years on the interest only, and then they're going to assume you're going to do all of your capex you planned in those first 2 years, so that at the end of the year, or the end of the 2 years, you're going to be at that full amount anyway. Okay, this is usually for like value add type plays. So they're giving you 2 year grace period to get up to a stabilized point, do all your capex, raise your standard of living to get the increased rents and everything, and then charge you whatever for the full amount. But if you don't do all your capex in that first 2 years, then you're going to be charged regardless for the amount of money that you may or may not have drawn on. And so you just need to understand what those are. And get this, this is what's the most frustrating thing about it is you don't even really know what those terms are until you sign the document on closing. You realize that? You don't know what the draw terms are. You know what they are. You know what the interest rate is. You know what the term of the loan is, amortization. You know all the prepayment penalty. You know all of that up front, but you don't know like what you're going to be charged interest on the draw until you sign the documents at closing.
surprise.
Yeah, and that could be a rude awakening. Most of the time, people sign it anyway because they're excited to close and they don't even realize what they're signing. Now, granted, if you don't sign it, you don't close, and so then you're in a pickle anyway. So these are some questions you need to ask up front before you choose a lender or debt service or whatever. So, um,
So I mean,
any
prepayment's a pretty big one. Why don't we talk about prepayment?
okay, so prepayment. Um, with interest rates climbing the way that they have been the last few years, I've been seeing a lot of yield maintenance prepayment penalty. Um,
Okay.
back in like 2021, 22, 2000, what all or 2020, that time period, I saw a lot of step down. Now the difference in step down and yield maintenance is step down, say if you're a 5 year term, your step down is going to be a 5% if you pay it back in year one, 4% if you pay it back in year two, 3% if you pay it back in year three, 2% if you pay it back in year four, and then 1% if you pay it back in year five. And there's some grace period, because at the end of the term, you are expected to pay it all back, and you're not going to get a prepayment penalty if you pay it back within like a certain window. Yield maintenance, on the other hand, is this is a funny thing. So typically, and this is how I teach my students, is people invest in debt. Okay. So say, yeah, you see how we're investing in real estate, other people invest in debt. So if someone invests in debt and they're giving you debt at a certain percentage at whatever rate, and you're supposed to hold it for 5 years, they're assuming that debt is going to be the same, or their investment is going to yield a certain amount, right? But if you pay it all back beforehand, they're going to
How dare
miss
you?
out. They're going to miss out on a large portion of their investment, and so that's where prepayment penalties come in. It's like to at least get those lenders at least made somewhat whole because they're putting up money for 5 years expecting a certain return. Now, if interest rates start to climb, what happens?
You pay more in interest.
Well, let's assume we have fixed rate on everything.
Okay.
A prepayment penalty. So if interest rates start to climb and you have yield maintenance, what happens is your um
Cost.
no, I'm thinking I'm talking your as like me and then also as the lender. Or yeah, so assume I'm a lender. If interest rates start to climb and you pay back early, I can take that money and invest it in something new at a higher rate than I was getting with you. Okay? Because interest rates are higher. And
Yep.
so your prepayment penalty will actually be less for you if interest rates climb versus if interest rates decline. If they go down, your prepayment penalty is going to be higher for yield maintenance. Because if interest rates drop a point and a half, that means I'm going to lose a point and a half from you. And if I go and reinvest it, I'm not going to get that same return I was going to get with you, with somebody else. That makes sense?
Yeah.
So
It's like the cost of doing business. It's like they can put it to work somewhere else.
yeah, yeah. So for yield maintenance, if interest rates are climbing, yield maintenance prepayment penalty goes down. If rates are dropping, your prepayment penalty goes up for yield maintenance. For step down, it's just pretty much straightforward depending on the year you're in and you pay it back. So
All right. What
um
about the third one, the hard one?
so what there's defeasance, which I
Yeah.
are you what is your take on defeasance? I haven't had too much experience with that
I've
personally.
had
So
no experience with it either. Yeah, that's why I was wondering if you had any. I guess not.
so I sort of know what it is, but like I said, I don't have experience with it personally. And this is probably a question we should have asked Julie when she was on.
Yep.
But instead of paying off the loan, my understanding is you can substitute treasury securities that will make the remaining payments somehow. I'm not sure again. This is typically for like CMBS or commercial backed security, commercial mortgage backed security, and some other loans that are securitized. So,
So a lot of agency debt.
well, I haven't seen it on like the Fannie Mae and Freddie Mac. I've seen like step down and yield maintenance on those, but like I said, I haven't seen defeasance except mentioned with CMBS. So, um, so where you see it, CMBS and some Fannie Mae, Freddie Mac loans. So, also some terms that you may or may not have known about when you get your loan is a lockout period. A lockout period is a period where you cannot pay back that full amount of the loan for anything. No prepayment penalty is going to do anything. You just can't get out of it. Um, so for an example, you might have a 10-year term, you might have a 2-year lockout and then yield maintenance after that. So those first 2 years, you cannot pay off the loan. You can't sell it and get out of it unless you can get the other people to assume it. So,
You're stuck with it except for assumptions.
yep. So, and we talked about assuming a little bit last episode, but an assumption is you can take over the loan in its existing format. So suppose I have a property I'm selling and I have a $5 million loan on it. Frank, you can buy that loan at the same terms I have. Now, granted, that term or that loan is going to be from when I get it to when I sell it. Say my term is 5 years and I'm selling it at year 3. That means you have two years left on that term. So you have to understand that when you assume a loan, you're picking up where they left off. You don't just start it over at the point you get it.
Yeah, if you did, then people would be buying and switching everything all the time.
Yep. So a lot of times you'll want to assume a loan if the interest rates are good or significantly lower. So we've seen a lot of assumable loan properties lately where interest rates are in the 2-3%. Um, and yeah, they could be good loans, but then or good properties, but then you have to realize the original people bought say a $10 million property at 70% LTV, so they have a $7 million loan, and now they're selling it for 12 or 13 million. So that means your LTV is going to drop significantly. I've seen it less than half less than 50%. So if you're okay with raising enough capital to overcome that, that's fine. If that buys you the interest rate that you need, otherwise it might be beneficial to take out a whole new loan. So
Well, it definitely makes the deal safer, but at the same point, it reduces your leverage.
yeah, and real estate is all about leverage. So for the most part, if you're talking about financing, it's definitely about leverage, and that's what this little mini series is about. So
All right, so the next thing that we see a lot is deals that have full recourse or non-recourse. What do you consider
so
recourse?
so full recourse, and we talked a little bit about this when we talked about the loan types with bank and bridge and agency. Full recourse is you and I are on the hook for the property, for the loan amount, regardless of what the property is.
Yep.
Non-recourse is the property's on the hook. So if the bank forecloses, you owe 5 million and the bank sells it, or and the property's valued at 3.5, the bank captures it and sells it for 3.5. For full recourse, they would come after you and me for that extra 1.5 million. They would go into our pocketbooks, and the way recourse is suppose I'm a 90% member of the LLC that has a loan and you're a 10% member.
Yep.
But you have all the liquidity, and that's why I partnered with you. They don't care if I have 90% ownership of that entity that signed the loan. They're going after the cash. And so if you have all the liquidity, they're going after your pockets before they're coming to mine. So the only recourse you have against me is if you then take me to court for the difference of whatever our percentages is. But the bank doesn't care about that. They just want to get paid. So
Yep.
for non-recourse, if you owe 5 million, the property's worth 3.5 and they sell it at 3.5, they're going to eat that 1.5 million. That's just a loss for them. They can't come after me. They can't come after you. Now, granted, if you and I get foreclosed on, regardless, we are going to have a mark next to our name. Now,
Absolutely.
it might not affect our credit score per se, but it will affect the types of loans we can get in the future.
Yeah, let's just say that the average bank won't like you anymore if somebody has to take a property from you.
Yep. Now, there are things where you can have a non-recourse loan that turns it recourse. And so this is typically like a bad boy clause or whatever, where if the owner is not doing the things they're supposed to be doing, or they're misrepresenting some things, typically this is going to be like if there's fraud involved or doing things illegal, then they're going to come after the owner as if it is a recourse loan, even if it was a non-recourse to beginning.
I've seen some interesting ones with that recently. You got to be very careful with some of those carve outs. I saw one carve out where if the property was losing money, then it could become full recourse. And it's like, what?
Yeah.
Obviously, if the property is losing money, then that's one of the reasons why it's not doing well. It's not, nobody was stealing anything.
Yeah.
So,
And I was going to say, it doesn't have to be fraud. It doesn't have to be intentional or someone doing something illegal. It could be, yeah, if the property loses money, or say, maybe
if someone fails to produce their PFS and their liquidity every year.
Yeah, if they're not reporting the way they're supposed to, or if their DSCR drops to a certain point, and we've talked about DSCR, the debt service coverage ratio, before, and we'll talk about it again in the next episode. But if it drops to a certain point where the property is not able to maintain a certain DSCR, they can come after you and make it recourse. So I learned long ago that all debt is recourse, whether they claim it to be non-recourse or recourse. And like I said, even if it's non-recourse and you get foreclosed on, you're going to have a hard time getting future debt. So
that's what your reserves are for, right?
Yeah, and reserves are another touchy subject with some lenders. You and I both had worked with a bank where they needed a certain amount of reserves or deposited into their bank. So
Yep.
the way the banks work is they have to have, and it's not so much as like law now as some as opposed to like their company policy, where they have to have so much liquidity in their bank for offering debt to others, and sometimes it could be as little as 10 to 1. So if they lend out $1 million, they want 100,000 in the bank. So that's their 10 to 1 ratio.
You mean our fractional banking system?
Yeah. Some banks will do 1%. Some will do 10%. Lately, I've been seeing banks wanting to do more, like especially your local smaller banks. They want to do 10 to 20%. And so you and I were looking at a refi from a local bank or a smaller bank. And they just said, yeah, you can get these amount of proceeds. You can get this interest rate for this term, blah, blah, blah. And you just need to have a deposit account. It's like, okay, what does that mean? They don't specify how much they need. But luckily, you and I have already been in the situation where we had to have money in an account. So I asked, well, how much does a deposit account need to be? And for a $4 million loan, they needed $1.4 million deposited into their account. Remember that?
Absolutely ridiculous. It's like 35%, right?
Yeah. It was like, so I mean, the interest rate looked awesome. The term was like 5 7 years. That looked good. Prepayment penalty was fine. Everything was awesome until we got to that point, and we're like, yeah, no, we're not doing that, and we hightailed it out of there. Now, for agency debt, you do have to have liquidity, which is
Right.
basically the same thing. But with that local bank, they wanted proof of liquidity deposited in their account. And guess what? You couldn't touch that account until the loan was over with.
Probably at 0.05% interest too.
Yeah. So with Fannie Mae and Freddie Mac, you have to prove your liquidity. Once you get the loan, you don't really need it anymore. You can go do whatever you want. But until then, you have to show that you're liquid. But with the smaller banks, you have to prove you're liquid for the entire time of the loan. So those are some reserves that you can't touch. Escrow. Some banks will want escrow, taxes, and insurance. So if you're familiar with a single family house, and you have a conventional mortgage, you're escrowing your taxes and insurance anyway. So you understand that. Replacement reserve. Sometimes lenders will want those escrowed, or at least they'll want to see them, where they want like $200 per unit per year. So if you have 100 units, you have to have $20,000 put in by the end of the year for it every year. So operating reserves. I typically tell my students to underwrite for 3 to 6 months of debt service and operating expenses. But some lenders, they want to see 6 to 12 months of debt service, and that's it. They don't care about operating expenses. They just want to make sure they get paid. So if they need 6 to 12 months, you might want to put that in. Sometimes they want that escrowed into their account again, so that there's always sitting there, and just in case something happens. Um, and you and I have been on a loan where we had to forward 3 months of debt service to them,
Oh yeah.
and it's just sitting in their account. They're collecting interest on it. We're not getting anything on it, and we don't have to pay the debt service for like 3 months. So,
Huh.
uh, um, any other reserves or anything else for
No, I mean,
that?
not that big of.
Okay. Um, so what one we talked about loan assumptions. Uh, have you ever done anything with supplemental loans?
I mean, we've done like seller seconds before.
So My understanding on a supplemental loan is you go to their primary lender and then you get more debt added to it at a later time.
At a higher rate or a lower rate?
Typically at whatever rate it is currently. Um, so not all banks will do that. You have to negotiate it, and typically, I don't think that's even in anything. You have to go to the bank after the fact and talk to them to see if they'll do it. One thing we didn't talk about on our interest rates last episode was an interest rate floor. And what would happen if, say, the SOFR went to, say, 0.1% or the 10-year treasury went to 0 or something like that? Yeah, you'll have your spread of like, say, 2.5%. So then you'll be at like 2.6 or 2.5%. But a lot of times the bank will put in a floor and say, we're going to charge you a minimum of 3.5 or 4%. So it doesn't matter if it drops below that, you're going to be stuck at that 3.5 or 4%. So that's another thing that you will see. And typically you will see that. And again, when you sign the documents on closing day, you may or may not see that beforehand. So another term you need to get familiar with are extensions. So with bridge debt, bridge debt typically has extensions, and you have to pay, usually it's 1% per
1%.
year. And when we first got our first deal, we got bridge debt and we thought we would refinance it into the permanent debt. And our interest rate was 5.99, and permanent debt when it came to refinancing was 7-8%. So it didn't make sense to put it into something else. So we extended it for 2 years. And
A little long.
Do what?
I was joking. I was going to say a little. We thought it was a little long at the time, but good thing it wasn't a little long after interest rates went up.
Yeah. So we extended it a year, and then we extended it again another year. And so you want to see what the extensions are. Extensions are typically for like bridge debt. If you go to bank debt, they don't really do extensions. They sort of just auto extend. And this would be like what we talked about last episode. It's like every 5 or 3 years, it'll extend it automatically, but it might be at a new interest rate. With extension options with bridge, you typically pay your percent and you get the same interest rate and everything. You have to jump through the same hoops or whatever that you got. But that's one thing. So, anything else that you can think of? Other terms? DSCR is a term. Again, we'll talk about that in the next episode. But for the most part, these are things that you are not going to see until you sign the closing documents. And if you don't read them, you're not even going to know you see them. So,
yeah, I mean, when I think of terms, like we said from the beginning, it's not just the interest rate. It's how long the length of the loan is, whether it's interest only or not, whether it's fixed or not, what we have to keep in a bank and reserves, stuff like that, all affects the mortgage itself. Have I walked away from mortgage offers? Yes. Do I like to? No, especially if there's nothing else. But if I'm going to walk away because of that, there's got to be something either wrong with the property or just something that takes a while to fix.
yeah. So if you want to learn more about financing and lending, you can catch the other episodes of the series. You can look me up at ironcladunderwriting.com. I'm on LinkedIn, Instagram, Facebook. Frank's the same. And we'll catch you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.